The first issue is the super debt cycle is to its end. I think the market understands that. The second issue is if interest rates is on the upside, the growth did not pick up as strong as interest rates increase indicated, the market valuation have to adjust accordingly. That's what we observed in the past few weeks. And obviously, the market is very fragile. So I think that's the whole thing expand for the future. But I will say, looking forward, the huge volatility is back and forth, and also the frequency of the volatility will continue to be with us. Let me explain. Last year, we record the largest market volatilities across all different asset classes in the US and in the world. We measure volatility by, say, daily volatility against the 100 days moving average. So we see how big is the number of standard deviation moving away from 100 days moving average, right? So statistically, it's very clear, it's very important. We record 6 standard deviation from S&P moving last year, which is the biggest volatility since 1929 in US history. We record 7 standard deviation moving in the US 10 years bonds market, which is the largest one since 1972.
Yeah, no, we felt it. I guess the question from here is, if we're not in a global recession, could all the financial volatility itself lead us there? Jamie Dimon of JP Morgan earlier in the week telling us that it rarely happens where financial markets actually yield recessions on their own, but it did happen in 2008.
No, I don't think it's a meltdown. I think we will see more volatility, but it's a short-term back and forth. And I do think we'll have an impact on the growth, but not as a meltdown, not across the situations. So we'll continue forecast the 3.4% growth rates for this year, but I have to emphasize the risk is on downside.
Min, in moments of volatility like this, do we need more liquidity in the markets? Of course, we've got the Fed in tightening cycle. We heard from a dovish ECB yesterday, Bank of Japan next week. When markets are suffering like this, do they need to inject liquidity?
Markets have a structured liquidity illusions. I think there's 2 issues. Dollar getting stronger, that's one thing. But the more important thing is, if you're looking for the Fed balances, actually Fed balances was shrinking in the past 18 months, roughly more than 2% of US GDP. If you compare with 2 to 3 years ago, every year Fed balances expanded 2 to 3% of GDP, which is a big liquidity soak from the market. Yes, ECB and the BOJ continue pumping liquidity into the market, but it really not comparison with the dollar liquidity. So dollar liquidity is very tight today and compared with 12, 18 months ago. The second issue is the market have a structure issue because we observed interconnectivity becomes such a big issue, spillover goes so fast. The real issue when interconnectivity expands, the market co-movements increase dramatically. Before the crisis, across the different classes of assets, market co-movements coefficients are roughly 20 to 30%. Today, 70 to 80%. Now, that's the implication for liquidity. If the co-movements increase 80%, everyone moving to the same direction, liquidity we found drop dramatically. Now, that's a real concern. So I think it's very important to central bank to understand the market liquidity situation, understand when the co-movements move dramatically into one direction, they need to prepare the liquidity for the market.